Hello and welcome to Come Learn Forex. In this video, we will be having a look at more Forex terminologies, continuing on from one of our previous videos. Please read the following disclaimer carefully by pausing the video before moving on. So in this video, we will look at spread, slippage, and hedging. Spread is the difference between the ask and the bid prices, also known as the buy and the sell prices. Spread is usually quoted in pips and is considered a type of inevitable commission. What you would usually find is that the best brokerages are often the ones with the lowest spreads, which helps a trader obtain a more accurate entry price. Please note that about 10 p.m. GMT, brokerages reobtain their quotes, which causes spreads to widen for about 30 minutes to an hour. In most cases, it is not a wise idea to trade during this time. Here is an example of how to calculate spread. So let's assume our ask price is 1.41225 and our bid price is 1.41213. We simply find the difference between both prices by subtracting one another, and we get 12 points, which is 1.2 pips spread. Slippage is when the price at which a trade order gets executed does not match to the price at which the order was initially made. This normally occurs during times of increased volatility, and noticeable slippage of more than a pip or two does not tend to happen that often. For example, if a trader had a buy limit at 1.39 and the price at which his order gets filled is 1.38994, the slippage would be equal to 0.6 pips. Unfortunately, there is no feasible way for a retail trader to prevent this. Hedging is when an investment is made which is designed to mitigate risk exposure. The process of doing so via an asset is referred to as hedging. Hedging has multiple different forms. A perfect hedge is when a trader is proportionally opened in the opposite direction via the same asset. For example, if a trader is already short on a currency pair and he buys back with that same size as his short order, his profit or loss would not move regardless of where the currency pair goes. An imperfect hedge is when the volume traded differs in both positions on the same asset, or when there is a different asset involved. For example, shorting GBP USD and buying Euro USD would be a hedge regardless of volume, as in one scenario the trader is selling GBP for USD and in the other is using USD to buy euros. This way, if the dollar goes down in value and the GBP USD investment starts going against the trader, the Euro USD investment will be technically going in the direction of the trade, even though not proportionally, which is still effectively mitigates risk exposure. If you have enjoyed this Forex related content, please do not forget to like and subscribe. Also, comment below on what you would like to see next.